10-year note yields held the recent range, that 203 to 214 range we set back on July 11th. Market just seems to be trading up, testing the high. Hasn't really tested the lows since we were down there last week. But again, the market kind of hovering in the middle at most of that period today, ending the day closer to the highs than the lows. But we are again holding that range as we look at not only what's happening with the data. We got strong retail sales data this morning. We got Mr. Powell speaking this afternoon, who reiterated what he said last week. And then we got more China-U.S. trade negotiations kind of going sideways. And all of them kind of pull the market in a different direction. And right now, the market's just going to kind of wait and see. We've talked about this before in that the market's waiting for that catalyst moment, that event that's likely going to be July FOMC and won't occur until July 31st. So we have a little bit of time between now and then. But again, the market seems to be coiling and waiting for something to happen. And likely it is forward looking to July FOMC. And if you look at market volatility, yesterday it was up a touch and today it was up a touch again. So it's two consecutive up days in Treasury volatility, which has been rare over the last several years. Moments to moment we've had upticks, but it's been rare to see consecutive days, especially over the last month. And I think at this point, this is all attributed to the China-U.S. trade negotiations. I think it's just a stark reminder that, one, they're not there, they're not finished, they're not resolved. And secondly, there is going to be an adverse effect to when we get things that are negative, and we got some negative headlines today. More, unless you just want to say that the U.S. could impose more tariffs is a positive, but I think at this point that any sort of trade battle is going to be perceived as negative, and it gave bonds a little bit of a bid. We saw the stock market come off its highs on that news as well. So again, the trade talks, which have been disappeared from the headlines over the last week or so, are back, and certainly have to make room for them. They're going to continue to hog the headlines until there is some kind of resolution, and when that is very unclear. Heading out the rest of the week, we are going to continue to get some more earnings. We had some bank earnings. They're mixed. It's not necessarily that the banks aren't doing well. It's just that with the Fed looking to lower rates, it's going to hurt their net interest margin numbers, and that'll probably drag down some of their forward guidance. So possibly that's something to watch. Also, the Fed remains a focus. We had several Fed speakers, including Mr. Powell today, who again reiterated what he said last week. Nothing new there. The Fed stands ready to do. Mr. Kaplan from Dallas, he also reiterated that a rate cut is necessary. However, I think he kind of tried to stress that a 50 basis point cut is not in the cards, and that sort of pulled back some of the expectations for a 50 basis point cut at the end of this month. So right now the market hanging its hat on 25 basis point cut at the end of the month. We'll continue to watch earnings, and now again we throw China and the U.S. back up on the radar. That will continue to sort of pull and mess more with the stock market than the bond market, but the bond market will react to what happens in the stock market, as has been the case for so long. So right now, bond market just seems very comfortable in this new range that was set last Thursday, but things can change very quickly, and I think at this point the risks are for yields to go lower and not higher in the short term. And then again, we look at July 31st as our catalyst moment, how the Fed points towards the next rate cut, point towards its forward guidance, point towards inflation in the economy. That will give the bond market something to really sink its teeth into, will give us a bit of a directional move. We don't know where that is yet, but obviously I think risks again are leaning towards lower yields and higher prices in the bond market, given the fact that the economy, while good numbers today, hasn't seen a sustained period of positive expansion, and there is some concern not only over inflation but now concerns over growth, and that could be a thorn in the Fed's side between now and the end of the year.